Amid the decline in lending and bank deposits at small banks, U.S. credit conditions have fallen to post-pandemic lows, according to the American Bankers Association. Furthermore, U.S. credit conditions are expected to deteriorate in the next 6 months to their worst level since the pandemic, according to a survey of chief economists at 15 of the nation's biggest banks. Taking all that into account, banks could see lower quarterly earnings and a weak 2023 outlook this earnings season. Joining us now to discuss is the Fed guy, blogger, and monetary macro chief investment officer, Joseph Wang. Great to have you here with us today. Joseph, first and foremost, as we start to think about some of the bank earnings that are set to ensue this week, what most notably would you be tracking, especially with regard to the banks that are most consumer facing versus those that perhaps have more business or investment banking exposure?
Well, thanks for inviting me. First, I'd like to note that it looks like the banking panic is largely over. The two data points that I follow, the Fed balance sheet data and prime money market flow data, are showing encouraging signs. So when a bank is in trouble, they borrow from the Fed as lender of last resort. Weekly Fed data shows that borrowing is declining. And we also show that money is going back into prime money market funds. Prime money market funds lend to banks. And during the panic, people were pulling money away from the prime money market funds. That's all coming back. So that tells me that the banking panic is over. And as you rightly note, we want to focus on the aftermath. How is that going to affect bank credit creation? As the charts you've show, it does seem to have some impact on small bank credit creation. And that's a problem, because if small banks aren't creating credit, then that means American businesses are not getting money, and that affects economic conditions. So what I'll be focusing on in the coming bank earnings season is how banks describe their impact on credit creation. Are they tightening lending standards a lot? Is loan demand being affected, and so forth? I suspect, though, based on the aggregate data and based from what I see in the banking system, that the large banks are going to be fine. They're going to be in good shape. There might be some small banks that are struggling, but we have to remember that America is a very big place. We have 4,000 banks, most of them small. And it seems like what happened over the past month was largely regional. So I'm optimistic. I think that we could have to move past this unscathed.
It's really interesting, Joseph, because I think we have two questions here. We have the question of soundness of the financial system, and then we have the question of profitability for the banks. And there, while the big banks might be okay, do you expect to see some kind of hit to profitability as a result of all of this for banks across the spectrum, not just for this quarter, but going forward into the rest of the year?
Yeah, I think that's a really good point. So going forward, I think many people are worried that the net interest margins of banks might be compressed because perhaps banks might have to pay a little bit higher interest expense for their deposits. But when I look at the banking sector as a whole, what I'll notice is that deposits have been very slow to reprice. So if the Fed is just and maybe hold rates, I think that leaves the banks with pretty fat net interest rate margins. The fact is that banks don't really purely compete on interest when they compete for depositors. They compete on basis of service, convenience, relationships, and so forth. And that's kind of how they can get away with paying so many people 0% on their deposit, even as the Fed hikes interest rates to 5%. Now, that's for the net interest rate margin, the loan portfolio part. Now, there might be some problems with the other aspects of the bank's business model. So suppose you have a bank, you have capital markets, you have investment banking, you have wealth management. Well, if we have a downturn in the financial markets, I think that will affect profitability in those segments. So it's going to depend a lot on how diversified a bank's business model is.
Okay, and so if this is true and the worst of it is behind us, then why would we hear commentary from the likes of JP Morgan CEO Jamie Dimon in his annual letter saying that we could still see some of the effects of this for years to come?
Well, there's a lot of uncertainty going forward. And I think one of the effects of this for the years to come is higher regulation. And, banks don't really like that. So the more regulation you have, the less profitability, right? Because complying with regulation is pretty costly. So I would expect there to be more regulation and that to have an impact on bank profitability. But from what I see, the indicators that I follow, I think the banking panic is over and we are on the mend. The problem is just how much damage that has happened, and we'll find out more.
Yeah,
weeks.
yeah. As you said, you'll be listening to the calls and to the commentary to see what more color we can get on lending. And so I guess the main question is here, the potential economic impact of banks tightening their lending standards. Can you talk us through that? I mean, you talked a little bit about that, about business growth and creation. Can you talk us through that a little bit more about the potential effects?
Sure. So banks create money. That's their thing. It's not so much that they take deposits and lend them out, but they create money out of thin air. So when you have very strong bank loan growth, what you're doing is you're adding money into the economy. And when you have more money, you have more potential purchasing power. People can go and buy houses, invest in their business, and so forth. So looking at credit growth is a really important leading indicator for how the economy will perform. So if you think back last year, there's tremendous amounts of bank credit growth, far above what we would expect in a typical year. So not surprisingly, we had a pretty inflationary economy, and economic growth was pretty well sustained. Now, going forward, if banks are closing down, battening down the hatches, and not making as many loans, and that doesn't bode well for the economy. There's going to be less money, less spending, and it would help accomplish the Fed's goal of dampening down economic activity and inflation. But there's always the threat of perhaps it having a bigger effect than anticipated and pushing us into a recession.
Yes, so something to watch very closely. Thank you so much for your insight on these topics. Joseph Wang, thank you. Fed guy, blogger, and monetary macro CIO.